Hey guys, welcome. Today I want to take a deep dive into my biggest loser, the stock that has lost me the most amount of money. More importantly, why I am continuing to increase my position. The company in question is the massive machine maker from the Netherlands, ASML, right here at the top of my portfolio. It's currently about a $14,000 position, and my intention is to buy more shares if the price proceeds to decline. In this video, we will be exploring what ASML does, looking at what I find attractive, and why they are a critical part of our future. It's going to be a basic overview of the bull case as well as the bear case. While I think the latter is unlikely, I will present both opinions and you can decide for yourself. Simply put, ASML develops and manufactures photolithography machines, which are used to produce computer chips. They are the only company in the world that manufactures extreme ultraviolet machines, which use a shorter wavelength of light to produce smaller, faster, and more powerful microchips. These machines play a crucial role in the segment of business known as patterning. Patterning refers to the process of creating intricate patterns on a silicone wafer by using light to print the design of an integrated circuit, enabling the creation of incredibly small and precise features on the chip. In other words, putting tiny little patterns onto silicone and doing it without critical error. Doing this takes tons of engineering knowledge that is gained over decades of perfecting these machines. This machine is incredibly complex. It looks so incredibly over-engineered. Like a million things can go wrong, but that's part of what makes ASML a monopoly. In order for other companies to disrupt ASML's market share, they have to replicate this device. And even from a brief look at it, you can tell it's no simple task. There's different estimates all over the place of how far other nations, like China, are behind ASML. They range anywhere from a few years to over 20 years. From my research, I believe that competitors like Canon and Nikon are at least 5 years away from making anything close to what ASML currently has. So, by the time a company can replicate this machine, ASML will be 5 years more advanced, making new developments and improvements. Not to mention, the companies that buy these massive machines want the latest ones from the most proven brand names with the reliable distribution and resources that ASML has perfected. A lot of these companies, like TSMC, Intel, and Samsung, have tailor-made positions for ASML in their warehouse. So, even if you could replicate these machines precisely, you still haven't passed through ASML's moat. You still have not breached their castle. To surpass this incredible moat, you would also need to overpower their enormous distribution and the fact that partners already trust and work with them. This is a multi-layered monopoly with both technical advantage and distribution. Large market share in a concentrated industry is a key factor of an outstanding monopoly. Now, if you're not familiar with the supply chain of making semiconductors and chips, then you probably don't understand where this company fits in or why it is a monopoly. There is an entire supply chain of companies that play a critical role in the chip manufacturing process. Each business plays an important role in certain parts of this chain. But in that entire process, ASML has by far the largest market share of this critical role, patterning. This chart exhibits the entire wafer fab equipment vendor market share of 2023. From left to right, you can see the complete process, each segment at a time, and what companies own the majority market share. As you can see, many companies are spread across multiple segments of the operation, like Applied Materials and Lam Research. Now, you may look at these two and assume that they are good investments because they are all over the supply chain, and you'd be right. Historically, they have been, but the corporation that has beat almost all of their revenue over the past decade is ASML. This company has outperformed all of them because they made the decision to go all in on this one critical portion of the supply chain. They don't compete with all these other companies. They don't play a role in thinning and CMP. They don't do deposition. They don't do much with dry or wet etch. Nothing with ion implanters, no metrology inspection, and not much with wafer bonders. But in the patterning, in this specific part of the whole process, ASML owns nearly 80% of it, with companies like Tokyo Electron, Canon, and Nikon retaining the rest. But this is slightly misleading because the segments of the market that they do own are the much lower quality chips, basically the less complex chips. They don't own any of the high-end performing chips that are used for iPhones, cars, AI, MRI machines, and industrial robots. ASML owns 100% market dominance of this high-end pattern making. As an investor, this makes the decision more clear. Would you rather invest in companies that are spread out across multiple markets, battling with a wide variety of competitors, or one that owns the lion's share of one critical part of the market? Those who are investing in ASML are opting for the latter. We want to own the entire patterning division rather than small portions of all the other segments. And the reason why is evident. When you own a monopolistic share of one critical segment in any large process, that leads to pricing power. Pricing power is what allows for exceptional margin, excess cash flows, buybacks, and dividends. This is a key indicator of market dominance and competitive advantage. When companies can charge practically whatever they want without losing customers, this leads to excess gains for shareholders. While having this moat is fantastic, it's not enough. We need to see long-term, sustained change in an industry or market that is likely to continue for a significant period of time, otherwise known as secular growth trends. We need to know why this company is going to get more customers, more pricing power, and continue to grow their distribution. Luckily for us, CNBC recently released a video that highlighted how every country is taking a stronger initiative to bring the construction of semiconductors in-house. For example, the United States. The US knows that they have a reliance on Taiwan for these advanced chips, and Taiwan is geographically close to China. This creates an alarming amount of geopolitical tensions and a reason why many investors, like Warren Buffett, sold out of TSMC. These scenarios may seem unlikely, but the implications for such an event would be massive. If China was to invade Taiwan and take over TSMC, this could cause a huge problem for the United States that relies on these advanced chips for military superiority, artificial intelligence, network infrastructure, medical equipment, and so much more. This is why the Trump administration has made a point of bringing the production of these chips to the US. Like this new Taiwan semiconductor manufacturing warehouse being built in Arizona. This is a brand new TSMC manufacturing plant, and the star of the show is, you guessed it, ASML. As there are more warehouses across more and more countries, all of them are going to need to buy new ASML machines. This is a trend that will continue. This is an incredible catalyst for this company's future, as you have every country in the world wanting less dependence on others. These countries are making significant investments into manufacturing. This sets up ASML to sell more and more machines. Their newest machines cost around $380 million. So it's not like you need to sell thousands of these things. You sell a couple and make a fortune. Another catalyst for ASML's revenue growth is the maintenance on these machines. As ASML makes these one-time purchase machines, they must be maintained perfectly. It is essential for these machines to be running around the clock, because if they are down for even an hour, the companies like TSMC could be losing hundreds of thousands of dollars. These machines are critical in the role of making fabs, so when they go down, the entire production line ceases to a halt. Once a client buys one of these machines, they basically have to have an expert service it. This translates to a very reliable, reoccurring form of revenue for ASML. So we've gone over some very attractive attributes of ASML, but they are not a perfect company. No company is. There are two primary bear cases for this company. First, A concerning characteristic that this company has is its high amount of capex and R&D. While it's true that ASML does have very high margins because they can charge so much, they are not a capital light company. To improve upon these incredibly advanced machines and always stay ahead of the curve, ASML is constantly reinvesting. This requires more and more research and development and capex. Obviously, you would like to see a company that can keep all of its revenue, but in most cases, companies that have this much of a monopoly require a meaningful amount of reinvestment. While this may be a concern for some investors, ASML retains about a 50% gross margin, operating margins that are now 32%, and profit margins near 28%. So don't be mistaken. This is not a company that is struggling to make money. Another massive concern for this company is with its exposure to China. The single biggest factor that caused the stock to sell off over 30%. This stems primarily from the US imposed restrictions, which prevent ASML from selling its most advanced EUV machines to Chinese companies. This is mostly due to concerns about potential military applications, hindering China's ability to develop cutting-edge semiconductors. ASML's management highlighted how this could cut expected revenue in 2025. However, even with these projections, they are still growing at double-digit revenue. A couple additional temporary concerns include higher than average inventory levels, particularly for their EUV machines, and a slower than expected recovery in the car and PC market. Overall, ASML may not be a perfect company. There are a multitude of factors to consider if you are buying the stock, but a comprehensive overview highlights how the good far outweighs the downside. While buying high-quality companies is important, not paying top dollar is just as, if not more important. In many cases, the highest quality companies trade for the highest multiples, and often this reflects the bright future ahead. But the perfect investment is buying high-quality companies selling at not so high-quality prices. I believe that is the case with ASML. When companies experience bad news, short-term investors are quick to flee, rapidly decreasing the stock price. Tracking back to 2023, you can see when I initially started buying the company. Very quickly, ASML became seriously overvalued. And in April of 2024, some real concerns caused me to sell my position, but I kept it on my watch list, waiting for an opportunity to repurchase. But why buy it back if there are such prominent concerns? By nature, these concerns are temporary. When we take a look at ASML, we know that the stock is flat year to date. Not only is it flat, it's down nearly 35% from its all-time high. That is a massive decline in share price. You're not buying it at top dollar. If there were no concerns, if the stock was up 50% this year, I would not be entering into such a large position. So these types of concerns can create real investing opportunities. The long-term reality I see is that we will be living in a world with a lot more chips and a lot more demand for advanced chips. As technology advances and we have more and more devices becoming smarter, like TVs and cars, the demand for these incredibly complex chips will thrive. Another thing I keep an eye on that helps sway my decision making is watching what the best investors in the world are buying. These super investors are so much better informed than any ordinary individual could possibly be. And one of my favorite investors with just an incredible track record is Dev Kantesaria of Valley Forge Capital Management. He does outstanding research and has a perfect investing philosophy. I recently made a video breaking down his portfolio, and just last quarter, he doubled his position in ASML, and his reported purchase price was $833. So really one of the only stocks that he's buying in today's market is ASML. and he bought it at least $100 more per share than what it's trading at right now. He has also gone on record defending this position often, articulating that based on his research, this is their most undervalued position. Dev says, "This is our cheapest name, trading at close to a 4.5% free cash flow yield on our 2026 estimates. Given that we expect free cash flow to increase at high teens to low 20% annual rate over the next decade, we consider the valuation and the potential shareholder return today quite compelling." Again, this is at a price of around $840. With all the information and research that I've gathered about this company, I think the potential upside is quite invigorating. In the short term, I would not be surprised if this company traded down further, or at least stayed relatively flat. But over the course of the next 3 to 5 years, I believe that there will be a big sentiment shift and an enormous growth in free cash flow.